Inflation has been rising at the highest levels since the early 1980s. Year over year, food is up 7%, energy is up 27%, used cars up 40%.
Especially that last figure. If you're shopping for a car or you need one,
tough time.
you know that. Gas also up as well. You know that if you're filling up your gas tank, up 40%. Today we're joined by Professor Brian Marks from the University of New Haven. Brian, thanks for joining us.
Thank you for having me.
Basically, everything in this world right now is more expensive than we're used to. Why is that?
Well, we're seeing a confluence of factors coming together all at once. It's almost like a perfect storm. We have demand side pressures and supply side pressures. The demand side pressures, people are talking about the availability of money in the pockets of consumers as a result of various fiscal and monetary policies. On the supply side, the pandemic, while hitting the demand side, has also hit the supply side. And with shortages of supplies of materials, we're seeing everything leading to increased prices.
But why does
as you've noted,
Brian, why does the stock market go down when that news comes out? Isn't that good for an economy, the fact that there's so much demand?
So remember, the stock market reflects the net present value of the future stream of income. Simply put, people are looking at what does the future bring and will invest today based on those expectations. People are expecting the Federal Reserve. Previously, they tapped the brakes a little bit over a year ago. They've been verbally signaling other changes. And so we are anticipating for 2022 increase in interest rates which will then put downward pressure on the economy. In other words, slowing down.
Right. So talking about the future and those interest rates, I think they said they were going to raise them some 4 times this year. So when are we going to see prices for folks who are going to the grocery store, who are getting gas? When will we be able to see relief? I know you don't have a crystal ball, but what you're saying.
First things first, gasoline prices, if we look at a barrel of oil, West Texas Intermediate, a little over a year ago was $35 a barrel. Today it's $90 a barrel. So we need to work through those things. It's going to take time for us to hit that new equilibrium, for supply to come on, as well as tightening up on the demand side. So it's not going to be instantaneous. It's going to take time to work through the economy. Is it going to be long term? We hope not. And the Fed is balancing its decision making. So we can expect March, the Fed is very likely, more likely than not, to increase interest rates. The question will be it be 0.25% or will it be 0.5%? Most people are thinking they may raise over the course of the year 1%. All of that will put some downward pressure on the economy.
Last question here, Brian. We see the news that the Fed might raise interest rates and might increase some pressure here to do so, and then the market goes down over 500 points today. With this volatility, is that market going to drop when the Fed does in fact raise those interest rates, or is that kind of effect already been seen today, and then when it happens, we're not going to see it so much on the stock market?
The market has been capitalizing in its expectations, Fed increases for some time now. That some of those adjustments have been occurring even as late as the end of 2021. So we can anticipate further movements. It's really when there's an unexpected policy decision. So if the Fed were all of a sudden to front load and say we're increasing interest rates by 1%, I think the market would be very startled by such a move in March.
A lot of factors at play. Professor Marks, nice to talk with you. Thank you so much for your expertise.
Thank you for having me.